I read an article on Seeking Alpha very recently, which I thought was quite interesting, titled "Don't Buy Real Estate, Buy REITs Instead." And what a REIT stands for is a real estate investment trust. The individual makes a couple of remarks that I thought were kind of interesting. And I know, Greg, you've had an opportunity to kind of read through parts of this article. But to summarize, one, he says, REITs have historically generated total returns far exceeding those of private real estate investments. Totally disagree with that. Number two, as strange as it may sound, private real estate investors took greater risks to achieve those subpar results. Totally disagree with that. Number three, quote, our REITs are able to grow their cash flow at faster rates thanks to better access to different capital sources. Okay.
Well, I could jump in and make one point, is that this is one of those examples of where people use a very broad definition and it applies to only a narrow band. When they say don't buy real estate, buy REITs, they mean don't buy commercial real estate through a private equity structure, meaning he's not talking to people that are buying a rental property. He's talking to people that are raising capital to buy a $100 million office building. And in that situation, I wouldn't even begin to know if he's right or not. But what I can say is the big distinction between both of the things he's talking about, both buying private equity real estate and buying REITs, is that when you give somebody else the responsibility to choose the property, to choose the market, and then to operate the property, you're taking a risk. That his bullet point here, that they took a greater risk, that's a very, very broad statement. We're big advocates that we want people to build their own ownership stake in America, which means if they ever want to liquidate part of that ownership stake, they can go and do it, and they don't have to ask anybody's permission. You can do that with a REIT. You can't do that with big private real estate. And so this is kind of there's two things about this. One, the guy's profile picture looks like he's 11 years old, so I don't know how many years he's had to test these theories, but I'm just teasing. I'm sure he's a great guy, and he wrote a good piece. I just wish he would have specified that this is, it's in Seeking Alpha, which tilts towards investors of securities.
That's right.
Wall Street type investors, not consumers. But a headline like that can take a lot of people by surprise and make them think that what the expert is saying is don't buy real estate, buy stocks in real estate. And we think that's a wonderful idea, but this is a better one, actually buying the real estate in your own account.
Yeah, the other thing that you lose is the control over the location, control over the property, control. And that's really, really important if you want to see the proper gains in a portfolio. And you need to have that input. If you don't have the input, then I would go say, it's just go buy.
It's real estate media. It's the same thing we always talk about. It's real estate media, which means, a great example. And this is a reporter or a writer. It's cool. He's a research analyst, but jumping to a conclusion in a headline that his recommendation is right for you without asking how old are you, what are your goals, do you have a family to support, what's your discretionary income, how long until you retire, what are your goals for retirement? Like, we wouldn't do that anymore. That you walk into a doctor's office and they hand you a bottle of pills. For some people, that's the reason they went there. But for a lot of people, they like to get diagnosed first. And so we're sort of big believers in the idea of diagnosing. Real estate investors right now have one of two choices until just recently when services like ours have emerged. You either could go to a realtor who didn't know what to tell you, so you had to figure it out for yourself, or you could give your money to somebody else who's going to manage it for you. And real estate really is the ideal asset class for you to personally learn yourself and then execute with the help of somebody who has also learned it. And that second part wasn't available until companies like ours came along, and there'll be others. They'll never catch up to us, I don't think, but there'll be others that basically you'll be able to sit down with somebody who understands this stuff, and if they don't ask you, okay, how old are you? What are your goals? How long until you want to see this real estate portfolio sort of mature? Then walk out, because they're trying to sell you something they want to sell rather than trying to show you the right way that fits for your plan.
No, that's right. For me, when I'm looking at real estate, I'm looking at owning a piece of America. That's it.
That's right.
Right? I do not subscribe to this, let me give my money to a fund manager on Wall Street and have them package up a bunch of pieces of real estate that they think are good. It doesn't make any sense for me. And for me, it's because I'm in the real estate business. I understand how to value property. I understand cash flow. I understand how to force appreciation. And I do, for me, because of my experience, and just like you, Greg, because of your experience, you have access to better rates. You have access to better capital. But not to say you can't build that into your model. You start doing one, you buy one, then you buy two, then you buy three, then you buy four. And before you know it, you'll have a portfolio of 50 or 60, and you don't have to give your money to these folks that are claiming specific returns because you're already doing it yourself.